Good evening, everyone. Bonsoir. Welcome. It is my great honor to welcome all of you to the MIPC 2018 event and this discussion panel with our industry leaders. My name is Jake Titleman, and I am the Executive Director of MIPC. This evening marks the official launch of MIPC 2018. It's an honor to have you gathered here tonight after many months of hard work and preparation. MIPC would not be possible without the efforts of our organizing team, our sponsors, and our advisors, so thank you to all of you. I'd like to welcome specifically our student participants, representing 12 countries from across the world. This year, we received twice as many first-round registrations as last year, which makes for a remarkably talented group of students. Before we welcome our panelists to the stage, I'd like to introduce you to our opening speaker. Benoît de Groseilliers acts as Senior Director for all HR and university-related projects within the industrial cluster of Finance Montréal. Finance Montréal works to enhance Montreal's reputation as a world-class financial hub and engages in international business development activities to attract foreign firms to Montreal. Its mission is to develop and promote Quebec's financial services industry. Finance Montréal fosters cooperation among a vast range of institutions to stimulate the industry's growth while raising awareness of financial specializations found in Montreal. Benoît holds an MBA, and he's a member of the Certified Human Resources Professional Order. He previously worked as general manager of a university's career center and was an HR manager at GE Money, a subsidiary of GE Capital. Please join me in welcoming Benoît.
Hi, everyone. I'm so glad to be here. You guys look beautiful. Welcome to Montreal. Welcome to Montreal officially. We are proud to support this great challenge. And it's a lot because of its universities that Montreal ranks in the top 5 university cities in the world, especially because of McGill. But Montreal is a well-kept secret. Maybe a few of you know that we rank in the top 20 cities in the Financial Center Index, or in the top 20 cities as a startup and fintech hub. And as Montreal Financial Cluster, we support events like that promotes Montreal. I'd like to thank the MIPC Executive Committee, and please join me and applaud. These guys did a great job. And I promised them I will keep that short. So Montreal's weather might be cold, very cold to some of you, but this weekend, because of you, Montreal's going to be very cool. So best of luck. Thanks, guys. Bye.
Thank you very much, Benoît. Hello, everyone. Welcome, distinguished guests. My name is Tatiana Demmick, and I'm the Managing Director of Sponsorship and Corporate Relations of the 2018 McGill International Portfolio Challenge. It is my honor to welcome all of you to the inaugural discussion panel with industry leaders of MIPC. C'est un plaisir de vous souhaiter la bienvenue à Montréal. This year, we have student teams coming from the US, Canada, Europe, Asia, and Australia, representing a total of 12 countries. Tomorrow morning, they will present their case solutions to a panel of pension industry experts. This is what makes MIPC so unique. It creates a platform that brings together young student talent from across the world, together with industry experts, to brainstorm and propose innovative solutions to the retirement savings shortfall, one that is especially prevalent just south of the border. As we all saw in this year's academic case, which illustrates the realities of the US public pension fund landscape, the case attempts to tackle the problem of underfunded public pension funds. It's a problem that's remarkably difficult to solve given the amount of stakeholders involved and given their conflicting interests. Here at MIPC, we believe that an alignment between the professional world and the academic world is necessary to address and solve the looming pension crisis. So without further ado, I'd like to introduce 2 exceptional panelists, Dr. Carl Robert, Director and Portfolio Manager of Asset Allocation at Intact Investment Management, and Dr. Marlene Puffer, President and CEO of CN Investment Division. I'd also like to introduce our panel moderator, Isaac Maciera-Kaufman, who's here with us from San Francisco. Isaac holds a Bachelor of Commerce from McGill University. He graduated just this year in 2018, and he is now working as a research analyst at Parnassus Investments in California. A small logistical point, we'd like the audience to come up with questions. If you have any questions to ask our panelists, please write them down on the cue cards that are on your seats and pass them to the left and right of the room, and they will be collected, and a couple of questions will be asked at the very end of the panel. So without further ado, please join me in welcoming Isaac, Carl, and Marlene.
Hello, everyone. Welcome again. So as mentioned earlier, tonight's topic is on the future of pensions and the future of pension investing. And before I introduce our two incredible panelists sitting right beside me, I'd like to give a quick overview of what we are going to cover tonight. So first, we're going to look at some of the large pressing problems that many pensions face today. In doing so, we're going to highlight some of the key characteristics of large differences between the Canadian and US model of their pensions. In doing so, we're going to dive a bit deeper into how many institutions are reaching for yield and seeking this additional and extra return on their investments before we tackle sort of the ongoing shift from defined benefit plans to defined contribution plans. And we'll finish it off with a sort of creative question to both Carl and Marlene that they have been working on for. It's a tough question. It's a question everyone's trying to solve, and that will be before our Q&A, as Tatiana mentioned. Feel free to write down as we go through our discussion if there's anything that pops up that you want to go a bit deeper into. We have Oriane and Pierre, two MIPC council members who will be collecting the cue cards as the panel goes on. And with that, we're extremely lucky to be sitting here with two incredible panelists. First, sitting right next to me, we have Dr. Marlene Puffer. Dr. Marlene Puffer is the President and Chief Executive Officer of the CN Investment Division. She is accountable for all aspects of the investment management and organizational oversight of the CN Pension Trust Funds, one of the largest corporate pension funds in Canada. She is the former Vice Chair of the Board of the Healthcare of Ontario Pension Plan, or HOOP, and past President of Women in Capital Markets. Marlene has more than 25 years' experience in investments, pensions, and capital markets at world-class financial institutions and in academia. Prior to joining the division at CN, she was partner of Alinvest Investment Management. Marlene holds a PhD in Finance and Applied Statistics and a Master of Science in Business Administration from the Simon Business School at the University of Rochester, and master's and bachelor's degrees in economics from the University of Toronto. She also holds the CFA designation and the ICD.D designation granted by the Institute of Corporate Directors. Maybe a warm round of applause for Dr. Carlin. Wow, my bios, my introductions don't compare at all to these. So
give it 25 years.
And then sitting right beside Dr. Puffer, we have Dr. Carl Robert. Dr. Carl Robert is the Director and Portfolio Manager of the Asset Allocation at Intact Investment Management, as well as the first Vice President of CFA Montreal. At Intact, Carl is responsible for the asset allocation activities and has been leading different projects and portfolios, such as new US and international equity portfolios, quantitative strategies based on US and Canadian Treasury futures, as well as one with credit default swap indices like the CDX and iTraxx. Carl has more than 17 years of experience in the capital markets, working for asset management firms both in Canada and in the US. So prior to Intact Investment Management, Carl worked at Sigma Alpha Capital, a global macro hedge fund here in Montreal, also at La Caisse de dépôt et placement du Québec, and Santa Barbara Quantitative Strategies, a hedge fund specialized in statistical arbitrage and managed futures. Dr. Carl is combining a background in physics, where he earned a PhD from the University of Maryland, followed by a postdoc at UC Santa Barbara, and both a master's and bachelor's in physics from Laval University. He also holds both the CFA and financial risk manager designations. So with that, another round of applause for both Marlene and Carl. So once again, we're extremely lucky to be sitting here right beside both of you. And just by going through these introductions, what is striking is that it's interesting not only that both of you are here tonight, but both of you come from very different academic backgrounds. So maybe if I start with you, Marlene, your academic training, how has your PhD in statistics and studying statistics and finance, how has it helped you today make asset allocation decisions and help you run CN investment division?
Well, I'm going to back it up a second to why did I study and go do a PhD in finance and statistics, and I did that when finance was really just beginning to be an important field of academic study. I did my degree in the late 80s and early 90s, and it was a time when finance had really just been about less than 20 years old, really, as a field. There was kind of a seminal book by Jean Fama that was published in 1971. And then, the theories that we all take for granted today, Black-Scholes and kind of these things that we think are ancient, aren't that ancient. They were created and developed in the 70s. And so I did that because I was interested in economics, but then I discovered the financial markets, and I decided that doing a PhD in finance rather than in economics would probably open more doors. And sure enough, it did. So it opened a lot of doors for me in my career. And when I decided to make the switch from academia to Bay Street, I switched into the field through fixed income. And it was a natural transition because fixed income is very much based on math and statistics and all of the theory that's behind the fixed income models that are out there is really quantitatively oriented. So the equity side has become more quantitative over time, but it was a natural transition for me to really go into fixed income. So it was a really helpful set of tools, and I knew how to do research. So knowing how to do research and use quant tools has been the backbone for everything I've done ever since. Even today, I walked in the door at CN Investment Division in March this year, and what was the first thing I did? Well, it was all about really statistics, because the focal point that the board has right now is around risk, and we'll be talking more about that this evening. And risk is all based in statistical modeling. There's really not a whole lot of new math since I learned it more than 25 years ago. You stopped counting at 25, just for the record. So all that backbone of quantitative methodology that I've had was the first set of tools that I used walking in the door. And it was, how are we going to measure risk? How are we going to talk about risk? How are we going to communicate about risk? And what are we going to do to manage risk even better than we already do? How are we going to achieve the same or better expected return with a lower risk profile, accounting for our liabilities? That's just a math problem. So it's really been the backbone.
Wow, great. And then maybe, Carl, many people might not see much of an overlap between physics and finance and investment management. So how has your PhD and academic background in physics help you with your day-to-day job running the fund?
There's a couple of points where it really does help, but first let me tell you a little bit what happened. Marlene was talking about the 80s, and it happened in the 70s. In 73, Black-Scholes, the famous formula, was they proved how to evaluate it, and the math behind it was from physics, and they won the Nobel Prize in economics in '97 for it. Unfortunately, Black was already deceased, but Scholes and Merton got it. And so the math is really from the heat formula in physics. So in '98, I did my first class in finance, and when I was in Maryland. And the professor was a math PhD and a finance PhD, and I got hooked. I mean, the math was stuff that I knew already, but it was a complete new field that I had no idea about. And I continued to do classes in that, and so maybe at some point, if I go into private industry, I'll go into finance, right? The other thing is also there was that in the 80s and the 90s, there was that quant call from Wall Street. So all these firms were having these prop desk trading, these hedge funds were starting to form. Huge hedge funds like Renaissance came alive, where they were hiring all those PhDs, doing investment strategies, but filling mostly their risk department, because a lot of math and a lot of models are required in risk departments. So they would, hire all these quant guys or women as well. And exactly. And so physicists, statisticians, mathematicians. But in physics, in applied, and me, my PhD was really in applied math and physics at the frontier between both. So it's basically numerical experiments with physics problem, but also with finance problem or engineering problems or biological problems. So for me, it was just another application, finance, of tools I already knew about. And now we call that data scientists. So now it's the big vogue, big data and all these things. Well, it's actually what I was doing my PhD. I was working with massive amount of data, trying to forecast them with different techniques. So basically, how it helps me right now, I would say it's at 3 levels. When I first started my career, I worked with a physicist and a hedge fund, and they were only using statistical tools to develop investment strategies. So it was basically programming all the time in C, and that was similar to what I was doing in university, but the outcome was an investment strategy that was put into the market. So that obviously is one thing, and it's one thing that a lot of people in science can bring to finance is the quantitative investment strategies. The second one is, I think Marlene got it right, is the research approach. Basically, when you do graduate studies, and a PhD in particular, whatever the field you're in, you learn how to be a researcher. And often in our fields, there's a lot of big projects that requires a research, and often they'll ask us to be in charge or be part of those projects. For example, I did one with Intact 2 or 3 years ago about the question was, we have all that data in our insurance company. What can we do? What can we do with it? Better while these new technologies, AI, machine learning, are coming in. So we did a big group, and I was in charge of it with a team of people all over Canada, and we had 6 months to come up with the answers. It was amazing. We found we did some pilot projects. We answered really narrow questions in a couple of months. Came up with the solution for the upper management, and we created after that a new department, the data lab. And since then, they've been hiring like crazy. They're hiring all kind of people. They have rotation of actuaries going in that department. And now it's mainstream, right? They talk about AI everywhere. We had a big fintech last week with Finance Montreal. It was great, by the way. A lot of people in Montreal. So the timing was great. So we did that 2 or 3 years ago. Now it's basically becoming mainstream in our business. So this type of project is another one. And a last one maybe, a lot of investments, especially in private investments, you want to hire people that invest money that have boots on the ground. What I mean by that, let's say you invest in an infrastructure project, you don't want just a financial engineer with your project. You want an engineer that does maybe finance, right? So you want a specialist in that field. Somebody working in technology, you might be a computer scientist that went to finance, and then that person is a specialist in that field. So by being a physicist, often those projects, for example, when I was at the Caisse de dépôt, I was in some projects involving energy. So energy in physics, we do that all the time. So it was easy for me, and I liked it because it was a direct application that I learned before to try to understand those energy problems in an investment setting. So you have there's not like a magic, one application among others. Some tools in physics are used in some investment strategies for sure, but mostly tools and approach to it, I would say.
I'd add one more thing, which is actually having gone so far to do a PhD, it's kind of soul crushing to do it. So what happens is when you actually manage to get it done, is you kind of come out the other end with a kind of a confidence that if I survived that, I can survive anything. And so there's a certain element of knowing that I had a strong skill set, I had the strong toolkit, but I also had some inner strength that kind of came from that particular experience of really pushing on something that you're supposed to be working on that, you know, is supposed to push knowledge to its new frontier. Well, I pushed it this far, but you know, just that mental exercise of trying to do something that is that kind of fine-tuned and developed, and being challenged by the best people in the field. I went to a very good school and was challenged by top people in finance and surviving that. So basically anything that's faced me since then has kind of been peanuts in comparison.
Great. I'm still in shock of having two great, experienced and well-spoken.
To be with you both, and Marlene, I've seen her on the panel before.
Yeah.
She's great. So
with that, let's dive straight in. So we're first going to touch upon some of the large pressing problems of pensions today. So looking at our current environment, so it's pretty unique. We have, I mean, other than historically low unemployment, modestly rising wages, we have historically low interest rates, although they have been creeping higher because of the Fed raising rates. If we look historically compared to previous periods, interest rates are relatively low. On top of this, we have a large demographic shift that's going on. We have an aging population. In many developed countries, people are living longer, and as a consequence, a lot of DB funds are quite expensive to manage. As a result, if we look at a deal that happened just 3 years ago, a historical deal in Canada, we had Bell Canada's pension plan that entered into a longevity swap transaction with Sun Life, and they transferred $5 billion Canadian dollars to Sun Life, where you'll have Sun Life, who's going to be responsible for paying the benefits to Bell Canada's current retirees, while Bell Canada pays monthly premiums to Sun Life. And this is just one of many ways that funds are seeking to de-risk and hedge their pension obligations. So Carl, I want to ask you, how do you think about both interest rate risk, longevity rate risk? How should funds, such as in Bell Canada's case, how should they approach this hedging of these different risks?
Yeah, so that's a great question, but it's only two risks that you were mentioning. There are other risks also worth mentioning. One of them is inflation. It's a pretty important one, especially if your pension fund is indexed to inflation. And the other one is a credit risk or a credit spread. So let me go a little bit on each of them, and I'll go a little bit more on longevity and interest rate. So interest rate risk. So basically, you want to match your liability with your assets, and so you want to target some hedge ratio. You know, that might not be 100%, might be 70%, 50%, depending on how you want to do it. And when the interest rate is really low like that, your liabilities become really high, right? Because you discount your future payments to your retirees to today, and the low interest rate is on the denominator, so you have a small denominator that makes the payment really big. When it was really going down for a long time since the 80s. So those pension funds are struggling because they cannot match those liabilities.
Because they didn't match them.
Right. So yeah. So if you have too much stocks, for example, and not enough bonds, because you want to make money, right? You want to have a good return, but you're not matching the interest rate on your liability. So one way of matching that liability, once you reach equilibrium between your assets and your liability, is to have more bonds. So you want to de-risk your portfolio. You want to have more bonds to increase the duration of your assets. And then what we do is that you can also have other derivatives to do that. So you can have interest rate swap to increase your interest rate exposure. And you can do futures contracts on bonds as well. So you have those three instruments, and you can and you can monitor your interest rate ratio with your liability. That's the interest rate part, all right? And then the question is the bonds, and you want to go corporate bonds, or you want to take, province, or you want to go with Canada bonds. Second one is inflation. Inflation, we want to monitor inflation, and this one is really, actually, it's probably the most important one, probably more than the longevity, I would say. And one way of doing it is with real return bonds. So basically, if inflation goes up, you get paid more with those type of bonds. And the problem with real return bonds is great. It's a great instrument. It doesn't give you a big expected return, but it hedges you really well for inflation. But it's one instrument. I just think there's not a lot of instruments to help you with that. But that's one that's really, really good for that. And then the credit risk, when you take a bond and it's with a corporation, you have a credit risk. And you have to match, if you do the discounting for your liability with corporate bonds, then you have a credit risk. And that credit risk can be hedged with corporate bonds, but also with CDX, for example, another derivative that can allow you to have an exposure on credit in general. And then longevity risk, that's what Bell did. So what they did is it's a swap for longevity. But there's different ways of doing those kind of things. You can do a buyout, a buy-in, or an interesting longevity swap. If you do a buyout, what you do is you take your balance sheet. Let's say you manage 20 billion in your pension fund. You take the 20 billion. You go see a life insurance company. They do this kind of thing. They say, okay, I have 20 billion here of assets. I have some liabilities. I'm taking that from my balance sheet completely, and I give it to you to that life insurance. Sun Life does that, Manulife, MetLife in the US. But then what's the deal, right? It's basically the pension, the retirees are going to be paid by that insurance afterward, okay? Well, is there a cost for that, right? Because the life insurance company says, hey, listen, you have a big longevity risk. Let's say maybe you're not in surplus in your fund, maybe you're in deficit. So your pension fund, you're gonna pay me to take off from your balance sheet, and then it can cost a lot of money. So the question: how do you evaluate that? And in some countries, it's not legal to do that. In the U.S., there's some restrictions, and in Germany, they're not allowed to do that. So go ahead.
And employees aren't always crazy about it.
Yeah.
They're exchanging the credit risk of the company.
Yeah.
For the credit risk of the insurance company, and it's not always a clear upgrade.
It could be an upgrade in some instances, but yeah, it's basically what's now. I mean, I work all my life for that firm. I paid all that money all my life, and then you guys are dumping me with. Politically, it's a hot potato, and it's really expensive to do as well. So take it really carefully before you do that.
Because guess what? The insurance companies want to make a profit on that transaction.
Yeah. And it's not clear how much it's really worth. So. So the buy-in is something in between, and the swap is actually the pension fund keeps the asset and the liability on their balance sheet, but they exchange the cash flow with the insurance company, and that cash flow compensates the pension fund if people live longer. So basically, actuaries, people like Bernard here would explain that much better than me. But basically, they have tables, mortality table, or let's call it longevity because we've been talking about longevity. So basically, when they upgrade their table of longevity, so if people now live longer, so basically the insurance company is going to send a cash flow to the pension fund to compensate them for the longevity risk. So basically you hedge the longevity risk. But the problem with that, though, is that they'll only take part of your so you have, let's say, a certain number of people that are retired. They'll pick and choose which one they want to take for themselves. So in the buyout, it's the same thing. They might not want to take all of what you have on your balance sheet. They'll take the good stuff, right? Oh, the things are not indexed when inflation. I want that. Or the people who don't smoke, I'm going to take those people. So they'll assess the risk, and they'll go à la carte and pick whatever. So you have to be quite careful. But yeah, people do that more and more. It's a market in expansion in Canada, for sure.
In practice, is there which one of these risks would you say is the most difficult to hedge? The inflation.
The longevity risk is the most difficult to hedge. We can't really hedge it in the market.
Yep.
So the life insurance companies have a bit of a natural hedge because they issue life insurance policies.
Yep.
So that's why you can trade it with them. But as a pension fund, that's it. There's really no other market in longevity. So otherwise, we're self-insured. So we essentially, if we own that longevity risk, then if we haven't earned enough excess return and managed all the other risks well, then that risk can stick out like a sore thumb. And then we end up with our employers, in our case, our employers making special contributions to make it up. So longevity risk affects different types of pension funds differently. And because it's who writes the check if people end up living longer than the actuaries think that they will. So in our case, it would be CN, the company. In Bell's case, Bell. So corporate pension plans, generally that's the case. And for public pension plans, it differs depending on the structure. For some, it may be the government. For some, it may be split between the government and employees. That risk-bearing and risk-sharing is an important part of plan design, where for longevity risk, it's usually the employer or the public entity. But for example, any other reason you end up in deficit, and it may be shared, or inflation risk is one that is often explicitly shared and has become more and more shared due to changes in plan design. So, for example, I manage the assets for Nav Canada that runs the air navigation systems, and it was a Crown corporation and was taken private, and they couldn't tolerate. The inflation risk was really, really hard to hedge. The actuaries penalize you for it, and it's all your fault, Brenna. So the best way to handle it was really to share that risk with the employees. And so they redesigned the way that plan works. Most of the public pension plans in Canada have gone to some form of risk sharing around inflation. So you might hear it called conditional inflation indexing or conditional COLA, cost of living adjustment. And the reason it's conditional is because it will be conditional on different things. It may be conditional on the funded status of the plan. It may be conditional on inflation being above a certain threshold. It may be conditional on some combination of things like that. And that conditionality means that it's not as expensive in terms of how much you have to fund today, because it's only kicking in under certain conditions. So that's been a big risk-sharing mitigant that has made the need to hedge inflation much less than it used to be for most of the big pension plans in Canada anyway.
Yeah, I think longevity risk is the most difficult one to hedge, but it's probably not the most critical to follow. Probably inflation is, especially going forward, is really one that could bite you. Because at least for the other risk matrix, you have some instruments that you can use. And those instruments, I'm not quite, it's good for, it's coming in, maybe in a couple of years, it's going to be more spread out. But it's difficult to use those things.
Yeah. Now the case of MIPC, it's based on U.S. public pension plans. And what is really striking, if I switch slides here, so here we have a funding ratio across the United States of each state's public plans funding ratio. And what's quite striking here is if you see just a vast amount of red, I mean, there's a sort of widespread underfunding across most of the United States. Merci. Mm-hmm. And what we see here is, so here we have a graph of the annualized returns of U.S. public pension plans versus the S&P 500. For 1, 3, 5, and 10-year periods. And we see that not only have U.S. public pension plans underperformed their benchmarks, but they also underperformed some of their aggressive targeted expected return assumptions. And Marlene, I want to ask, I mean, it's not normal to have these massive billion-dollar public-run funds that are underperforming their benchmarks by so much. So I guess the crook of the question is why has there been such a widespread underperformance in U.S. state plans?
Oh, so many reasons. But first, I just would like to talk for a second about what the relevant benchmarks are. So comparing the performance of pension funds to the equity markets only
Yeah.
It's not really a fair comparison because in order to have a reasonably balanced risk profile and to manage the risk against the liabilities, you have to have bonds in your portfolio. And generally speaking, equities earn a significant risk premium over bonds, so a balanced kind of portfolio is going to earn a lower rate of return. So that's point one.
Yeah.
But point two is that the evolution over time has been an interesting one, and it tells some of the story of why we've gotten to this sort of underperformance. And that is that when pension plans were first created, kind of early in the last century, many of them were created, CNs was created in the 1930s, there was a surprisingly sophisticated, when we look back at it, understanding of what should you invest in to finance the future payments you're going to make to pensioners. Well, guess what? They invested in bonds. And they invested in bonds because it was just logical that it should be a low-risk portfolio. And turns out that that's the best matching portfolio for pension liabilities because they're bond-like, but you can't really make those long-term enough. So then, things went along and people figured out diversification is an interesting thing. There's a free lunch in the financial markets and it's called diversification. So what's free about that? Well, you add another investment to the portfolio that's not perfectly correlated with that investment, and for the same risk level, you can earn more return, or for you can keep the same return and actually lower the overall risk. That's magical, isn't it? So lo and behold, again, kind of the actuaries came along sort of with this and figured out, we're going to do some research and we're going to figure out what's kind of an optimal portfolio to balance off this risk-return idea. And they came up with sort of this semi-universal 60% equities, 40% bonds was a pretty reasonable, balanced way to enhance expected return without going totally overboard on risk. Okay, so fast forward a little, and 60-40 becomes kind of the gospel. Okay, what's wrong with that? Well, what's wrong with that is that it relies on the equity risk premium to contribute return. And it forgets that now you've taken 60% of your portfolio and put it into equities that doesn't match those liabilities. Mm-hmm. And when interest rates fall, the value of the liabilities in present day terms skyrockets. Mm-hmm. So that's the essence. That's that simple, historical evolution is a big part of the reason why U.S. pension funds are underfunded, because they just missed the boat on falling interest rates and forgot about the idea of asset liability management. So then the question is, well, why'd they forget about that? And most Canadian pension plans struggled with it too, and it took them a long time to come around to this idea of, well, we should add some more interest rate hedging into our portfolio, and we're still kind of working on that. But the U.S. plans just totally missed it, most of them. So why? They missed it partly because most of them are, particularly the public pension plans, have a pretty poor governance model. And we have a whole lot of political interference that gets in the way. And you have people who are underpaid managing these things, and you have a lot of turnover of the senior staff in these pension plans, and you have government interference going, you know what, when you're in a deficit, we're not going to put more money in. So too bad for you. You've created a deficit situation and we're not going to rescue you. So the math, when you do the math, if a pension plan gets below about 80, 85% underfunded, when you do the math of what kind of return do you need to earn over time to get out of that hole, it turns into a death spiral. So the fact that they didn't rescue them when they got into the sort of 90% funded ratio, crept down to the 85% funded ratio, they basically created an impossible problem. Because I forget what the numbers are, but essentially you'd have to earn, when you get to 85%, you'd have to earn, double digit anyway, reliably, 12, 15% returns if you wanted to get out of the hole over a 7 to 10 year horizon, that sort of thing. So the likelihood of getting out of a hole by earning returns to get you out of it with anything resembling a reasonable portfolio, even if you just dumped it all into equities and equities skyrocketed like they have recently, you can't earn your way out. Your asset base is too low. So the big mistakes were too much risk that didn't match the liabilities, and then not plugging the hole as soon as the deficit started to arise.
And how exactly, maybe Carl, if you want to touch on this, how has the competition among U.S. banks, investment banks, and maybe buy-side funds, how does that affect the talent pool and the resources available to run these U.S. plans?
So Marlene put the finger on one important point. Governance is one of them. So, if you get a job, let's say, I don't know how CalPERS is now, but I think it used to be like you apply to be a public servant, basically. You work for the government, and the boss of CalPERS in California, they, changing the microphone. Yeah. So basically, the answer to the governor of the California, so it's really political. So basically, your public servant is great, but your salary is capped. So you cannot pay your personnel too much. So when they become really good, well, they get poached by someone else. And in the US, there's a lot of competition, right? You have all these hedge funds. You have all these before the crisis, there was all these prop trading in the banks, the hiring all these people. So if you're a pension fund in some city, right, and you work for a city council, and you have that pension fund there, you cannot really pay your people. So basically what you do, you hire consultants. So you are a consultant, okay, great. You have a great consultant, great asset mix and all that. It costs a lot of money. So the cost of that, I think, is one of the things is the cost is hidden. So you pay all these consultants, and you pay those strategies with big fees, and it's somewhere in your balance sheet and your annual report, right? All these are expenses, and then you have your salaries, and then the politicians, oh my God, you pay your people too much, when in reality, typically, the salaries are about 1/10 of what you pay for the outside fees. And the outside fees pay those big salaries for those older people working for these hedge funds and so on. So if you would put, if you would put on your annual report, you put how much you pay for your employees and how much you pay for your external managers on an equal basis, then you would have a big difference. Then you would be able to hire better people, you would be able to retain them. And I think that's one of the big problems. I mean, if your fund was in New York, I guarantee you, and my fund as well, we're in New York tomorrow, half of if not 90% of our personnel will leave. I mean, they have like 100 hedge funds knocking on the door. Oh, this guy's good. Come here. Your salary is times 5 or whatever, right? I mean, whatever you want, tell me. I mean, it's like, that's what it is. It's competition, right? So in Canada, in general, we have a bit less competition. There are a lot of different, in banks, we have a couple of banks, in pension funds, it's the same thing. The big public pension funds are, there's a couple of them. So the competition I think is key, and to be able to retain them. I don't know if you want to talk about it now, but the public pension funds in Canada, the famous Canadian model, one good paper by Miville and Annick that they wrote 2 years ago by the Bank of Canada. They do a survey of the big 8 public pension funds. They call it the Canadian model, where you have the CAIS, you have PSP, you have teachers, have all these big funds in Canada. And what's the difference with them? Why are they able to get bigger returns with a lower fee than most people? I mean, scale. They manage a lot of money. They hire a lot of good talent. And some of them have some governance issues, but most of them are not directly under the government. They are para-public. They are somewhat beside the public sector. So they allow, or they're able to pay their people better. And sometimes it's very competitive with the private sectors. Even in Montreal, they're able to compete with the private sector. So people are sort of, so they have access to really good people that otherwise they would not have access with the same price. So it's kind of an ecosystem by itself in Canada. We're sort of lucky in a way. Those big firms are lucky because they have these really great talent, and they retain them more.
But before we leave the topic of the U.S. plans, the other thing to note is the regulatory environment. That the way that plans are able to show their funded status In the US, they can use much higher discount rates than they can in Canada. So the problem has been hidden, partly because of that. So they're not as heavily regulated, and the different sorts of rules have allowed these problems to kind of fester long before they got fixed.
How does the politicization of some of these funds, as Carl mentioned, can you provide a bit more color on how the politicization of these funds, how it affects the decision to have more in-house versus external consultants?
Yeah, so I think you really hit on the big issue, which is how they can pay people. And the other piece is if you have talent who can choose where they want to work, and you try to convince them that the place to come to work is where you never know when the government may just come in and decide through the board and the board's appointments that the investment strategy is just going to shift and, oh, oopsie, no more hedge funds for you, which has happened a number of times. And, CalPERS, as an example, has kind of come in and out. Texas, where all your decisions are out in the public domain. So a number of the U.S. plans have to publish the minutes and all of the detailed presentation material of all of their investment meetings. There's a lot of public scrutiny, and so it really affects the willingness to undertake strategies that may be innovative, may be a little bit out of the norm, may appear to have some risk associated with them, but they may in fact be risk reducing. So there's an innovation lag when there's too much public scrutiny and too much transparency. Because the easy approach is to kind of do what everybody else does, and then it's harder to be scrutinized. But that's kind of why the 60-40 model kind of had too long of a life, and it was really slow for a lot of plans, and it's still slow for a lot of plans to really move into some of these other investment strategies that are low correlation with equities and bonds that add a diversifying factor. So that transparency is key, and the transparency creates that excess oversight in a way by those who aren't experts, and kind of creates this fear factor that limits innovation.
And if I may continue on that point, the scale of those big pension funds allow them also to have access to asset classes that the average or the smaller pension fund don't have access to. Private equity, private debt, infrastructure, farmland, timberland, all those asset classes, those big pension funds have access to them. They have the people, the experts in-house. They can go everywhere in the world. They make their own deals. The fees are going really down because they negotiate themselves. Often they bypass consultants or other funds, or they do it in co-investment with other funds. So the cost goes down. They have access to a higher expected return, and for smaller risk, because on the efficient frontier they go higher for the same risk and they get a higher return. You say it's more risky in a way because it's private, less liquid. So you have other risks than the one we mentioned earlier. Now you have a liquidity risk issue, and it could be a problem, and so on. Credit default of those firms or those projects. But they do have access to other asset classes that the others have access to, but for a big fee.
And so to focus a bit more on the difference between the Canadian and US model, what's interesting is that at CN, you manage both a Canadian and a US plan. And I guess my question is, what are the main differences you encounter when managing both your Canadian and US plan?
Well, that's a very good question, and I love this chart because it highlights exactly the point that Carl just made, that is scale. So we have a talented team in-house here. We have 80 people or so, and about half of them are investment professionals, and we have about 18 billion in assets that we manage for the Canadian plan. So our ability to use pretty sophisticated strategies and access all the asset categories that you just mentioned is pretty good. So you look at the little slice, that's our US plan, and it's, right there, 315 million. And it has to be managed as a separate plan. We can't invest it in the same trust fund that is our larger plan. It's separate jurisdiction and so forth and so on. So We have a much different model for it. It's managed entirely via externally managed strategies for which we have to pay higher fees. We have a committee structure that oversees it, and some of our internal, one of the people is in the audience today, we have some of our internal investment experts on the committee that oversees the U.S. pension plan. But it requires separate analysis of what the liability structure looks like as well. And it turns out for our U.S. plan, there's some funny stuff. So there's actually 2 U.S. plans, but they have funny liability structures that have funny inflation characteristics. And so we've actually, over time, as we've done deeper and deeper work with the actuaries, have had to cope with the fact that these plans have these strange properties. And so the investment strategy has to adapt to the fact that they're very different in terms of their liability structure compared to our main Canadian plan. And then we have higher fee base and fewer tools that we can really use within the U.S. plan to meet the objective.
And any cultural differences between Canadian and U.S. employees into how they approach their retirement and savings?
Cultural differences. Not that are affecting our investment strategy, I would say. I say the common theme is that we have union employees on both sides of the border. So union dynamics can often play an important part in how you communicate about your investment strategies, how they look at things like environmental, social, governance related topics. So there are a few things that kind of feed up through who are the members of the plan. But no, nothing that affects our strategy.
Gotcha. And if we focus now a bit more on the Canadian model, if we look at the big 8, the largest 8 public Canadian pension plans, we've seen a large shift into more capital being allocated to these alternative assets. And Carl, I want to ask, I mean, what's the role that these investments in private equity and other alternative assets, what role do they have inside pension funds as a defining feature between the Canadian model and the U.S. model?
Oh, in the Canadian funds like that, I mean, I've been starting to invest in those alternative investment in the 90s. Some of them have been doing that like early on. So it's been going on for a while, and now it's accelerating in mainstream. It's getting mainstream recently. But they have heads up. They have a big advance on a lot of even in you look at a big private equity firm right now in the world. The big pension funds are equivalent in terms of quality of team. I mean, it's equivalent. They work together after they do deals together. They have access to the best deals because they're huge, and they have the top people in their own firms to talk to these big private equity firms, for example, or infrastructure or whatnot. And they hire boots on the ground, like I told you earlier. They hire specialists, engineers in their portfolios to analyze different sectors. So it's becoming an army, and then an army of brains. And it's a great model, and more companies and countries try to replicate that model. It's the sovereign funds like in Norway and other places that are similar structures. So they're difficult to it's a scale thing when you manage hundreds of billions, and some of those funds, by the way, in Canada will be $1 trillion in a couple of years. So it's becoming. How do you manage $1 trillion? I mean, what kind of asset mix can you have? Can you really have the same type of asset mix? I mean, this does become constraints issues. So they have a big heads up in Canada for those big pension plans.
I'd like to just take a second to articulate what the different types of alternative assets are, because it's often all lumped together. And they have very different characteristics depending on what they are. So in some circles, alternative means anything other than public equities and bonds. So you've been kind of referring to it that way and referring to all the things that are not just stocks and bonds. But the characteristics in terms of their contribution to the risk of the portfolio are very different depending on which category you're talking about. So private equity, for example, when you look at the buzzword these days is what are the factors, investment risk factors that drive the performance of private equity? They're really identical to what drive public equity. It's the same thing. It's just an equity investment. It just happens to be private, less liquid, more premium potentially attached because of that. And there's a bit of an illusion because marking to market is smoothed. So you don't have the public market, volatility associated with it, but you have the valuation volatility, but it just doesn't show. So people are fooling themselves if they think that adding private equity is actually diversifying risk. It might, just because it's maybe smaller firms, it may be in sectors that aren't as prevalent in the public markets. There's a little piece of diversification, but it's pretty minor. So you're fooling yourself if you think adding private equity is going to help your risk profile. It may enhance returns. Net of fees, maybe not so much, but it may enhance returns. So it's very different to think about private equity and its role in the portfolio than it is to think about hedge funds, for example. So hedge funds are the opposite end of the spectrum that are designed to have very low correlation with stocks and bonds. So that's the free lunch again. So that, I was asked at a panel on Wednesday, what's the number one investment strategy that I see that, we're looking to add to. And my answer was, well, there isn't really anything that's a screaming buy right now, but we're just continually trying to look for strategies that have very low correlation with what we already have. I want more of that free lunch. So very, very different across the spectrum of alternatives. And, alternatives, like infrastructure is a little bit more of a liability hedging type of investment category. But longer term, but valuations are really tight right now, so the returns are not so good. Private debt is kind of everybody's panacea right now, and it's a pretty good asset category. It's got some diversification, but it's correlated with equities. But the other nice thing about it is it has a little more correlation depending on the duration you're talking about, maybe a little more correlation with your liabilities. And the credit spread component, at least for us, because of the way our solvency calculation is done, it's based off of a portfolio that has a lot of credit embedded in it. So credit actually helps us hedge our liabilities in a kind of a stupid regulatory way. But it's very, very different across the spectrum. So when you're looking at some of the US players and what they're focused on, there are those who are willing to go into hedge funds and there are those who are not. And the key is that if you're adding hedge funds into your portfolio, you're getting that diversification factor. But hedge fund returns are not expected to match the equity book. So there's been this delusion that, hedge funds are terrible because they haven't kept up with equities. Well, it's how are you using them in your portfolio? They are supposed to have low beta. It just happened to be that in the 90s, hedge funds had pretty high beta, high correlation with the equity markets. They kept up with equity market returns, which were more moderate. And so there was this delusion that, hedge funds are really giant performing strategies. Well, they're not. So they're designed to be low correlation, relatively lower expected return. But when you use them in an intelligent way in your portfolio, you can overlay them over top of the rest of your portfolio. So we do it that way. Most of the large pension plans in Canada do it this way, where we substitute in some of our bond portfolio, we substitute bond futures. So we use derivatives. That gives us cash. What do we do with that cash? We invest some of that cash in hedge funds. So we actually overlay a moderate return of a few percentage points over fixed income. But that adds to our alpha. So it's thinking about hedge funds in a more sophisticated, nuanced way as how do they contribute to the portfolio. And the trouble is in the US plans, they have trouble getting over that hurdle and understanding that the hedge funds are not a substitute for equity, but you can actually layer them on top. But you have to use derivatives to do it at the plan level, and you have to have your board on side for having some leverage, or at least perceived leverage in the strategy. And that requires a relatively more sophisticated kind of conversation than investing in a hedge fund. That's a strategy that's embedded, that you don't actually dig that deep into at the board level, and you ignore the fact that it's using piles of derivatives and sophisticated strategies because, those outside people are doing it and they're the smarty pants. So it is a nuanced argument about the distinction between many of the US and the sophisticated Canadian plans.
And other than hedge funds, how are some other ways that CN, you guys are searching for that additional yield? Any other asset classes that it seems as if the hedge funds, you look at it more from because of low beta, low correlation. What asset classes are you looking for that additional reach for yield?
Well, we have real assets, so we do have some direct owned private equity. We have private debt, where I'd say if there's any part of the portfolio that's going to get a little pump up, it's probably at the margin, one of the better ones right now. And we're big enough that we can invest in some good funds and get some co-investment opportunities as well. But we're not really in the big leagues on that. Real estate continues to play an important role, but valuations are challenging right now. So we've actually been making some switch from some of our more direct investment type strategies, and when we're adding to real estate now, we're adding more in the fund space that gives us more geographical diversification into the U.S., for example.
Interesting. And Carl, is there a way for funds to essentially search for this additional yield, take on a bit more risk while not putting the fund into too much of a mess? I mean, what can funds do to mitigate investing in more of these types of assets?
So I've been listening to you guys talking about risk and mostly to returns, but there's a big difference between total return, the capital, the return you get from the capital appreciation, and the income. So, I have to tell you that, at Intact, it's mostly money from the insurance company. So we manage $20 billion. $2 billion of that is the pension fund, but the rest is the insurance money. And the insurance money needs a much lower duration. And they really need income. So and the key is to create the best benchmark for your client. So we don't think, let's take the TSX or the S&P 500. No, what your clients need. Our client need a lot of operating income. Then you build your benchmark with a lot of operating income. So for example, in Canada, you have a lot of operating income from energy and from finance. Then there's a risk to those sectors, but you get a good income from that. So one way, the first layer is build the best benchmark you can in all the asset classes you have. Then the second layer is the added value. Do you have the team internally, or you can go externally, to add value to those benchmarks? And for us, the answer is in equity, they really have a really good team to add value over the equity. So we use that a lot with strategies that Marlene you just mentioned. And our typical, basically, it's like a hedge fund. It's not really a hedge fund. It's like a strategy, similar strategy that they use, but you use it internally, so you don't have to pay the 220 fees externally. And these teams, they're doing a great job. They're doing the same job as an equity analyst, but we just put the portfolio so that you can go long, short, or market neutral. You can use this different type of strategies internally. And you're consistent adding value. So that's the second layer. The third layer is you want to choose asset classes that give you good income for the insurance part. And for example, private debt is one that's pretty in vogue right now, but it's one that's interesting. Might be valuation might be too high, like most asset classes, but that's an interesting one. Dividends in some stocks is another one. But the search for yield, what are the typical asset classes, right? What's the expected return for stocks? Some say it's zero. It might be, it's probably between 0 and 5%, nominal. Take out the inflation, real maybe 3. So you don't have a lot of income, right? Of expected return. Same thing with bonds. The big risk for bonds is, the interest is going up. So, that's a big risk, right? It's overpriced. We saw the graphic earlier. The value of bonds is really high. It's still really high, even though the interest has been going up. So it's overvaluation in a lot of asset classes, including some of those private investments. But the yields is there, so people go there more and more in private deals, and you get the yield there, and try to scratch for yield every. There's not like a magic bullet. Just try to lower your fees in general, and have good teams to try to do it.
And I recently read this Financial Times article where they sort of highlight. If you look back in 2008, a lot of what caused the crisis was the banks being very overlevered both in the U.S. and the Eurozone, and how if we look at today, a lot of the banks have delevered, but the risk isn't totally away. What happens is actually, they argue that pension funds have taken on a lot of the risk that was held with the banks. So I guess my question is, when you have a significant number of all these derivatives, overlays, these hedges for FX, longevity, interest rate risk, when you combine these exposures to these illiquid assets as a result of this search for yield, how does that make it much harder to manage the risk?
Well, first of all, the banks, like you mentioned, have lowered their risk a lot since the crisis. The banks in the US, the capital requirements are much higher. They have more capital, they have better finance. In Europe, not as much as in the US, but it's better than it used to be. The big pension funds, they don't necessarily use more leverage than they used to. Probably not. They have access to leverage because they have a low financing cost. But they use that not only to increase their returns, but also to mitigate risk. You can use those instruments you mentioned is to hedge some risks. And you want to balance those risks as much as possible in different scenarios. So a lot of banks and pension funds have been doing those big shock tests, right? So what if a scenario in which inflation goes up a lot? What happens to your portfolio? If you have a big scenario of deflation, what happens to your portfolio? What about stagflation, where you have stagnation in economic growth, but inflation at the same time, like in the 70s? That's terrible. So you have no growth and inflation goes up. So that's another scenario. So basically, we look at those three main scenarios, look at all the metrics I talked to you at the beginning, and we try to even them so that the surplus volatility of the pension fund doesn't fluctuate too much. So you basically minimize the volatility of the surplus with those metrics. The longevity one is difficult to do, like we saw earlier. So that could be an additional risk, but I think it's more long-term risk. So I think that's pretty much yeah. I don't think there's more leverage for pension funds than they used to have. No.
They argue that because we're in such a low yield environment with high valuations, that shift to private equity and hedge funds, those investments carry some type of concealed
maybe a liquidity
leverage.
risk then. Yeah.
Liquidity risk.
Yeah, maybe more than that. Yeah, I agree.
I want to shift now to talking about the optimal structure of some pension plans. Marlene, CN division, I mean, it's a very successful DB plan, but it's amidst a wave of many, especially in the US, a lot of private plans shifting from offering defined benefit plans to more 401ks, more defined contributions. So I want to ask, I mean, is CN, the fund you manage, is it an outlier, or is it sort of a sustainable model that, that can be applied in other jurisdictions in other private companies?
That's a great question. The DB model itself is a really great way to run retirement money, but it needs to be run well. And we talked earlier about the problem when pension plans take too much risk in their investment portfolio and don't match it well enough against the liabilities, and then layer on that they don't make the contributions into the plan when something does go wrong to keep you above that kind of nasty can't get out of it threshold. So provided that a company, if we're in a corporate pension plan, takes the view that the governance of the pension plan is strong, that it begins, when you begin a new pension plan, if you begin that new pension plan with a prudent risk profile, like there's a few new DB plans there's one here, Lotto Quebec was created a few years ago, and they created it and took a view that they're going to really have a low asset liability risk profile. So they have a lot of bonds in the portfolio. They hedged that, and then they've added some equity, but it's quite modest. And it's fully funded when it starts. So if you manage it properly from the start when it's fully funded, it becomes quite self-fulfilling, that it will perform quite well, unless you really have a big outlier type of event. So the prudent governance with a smart approach to when things do go wrong, you have to be willing to top it up. And you need to figure out where that top up is going to come from. That's those are some of the key dimensions to making a DB plan really work well. And some of that risk sharing I talked about earlier around inflation exposure and the top up to inflation, that's such an important risk element that if that risk is shared, it can make the DB plan quite a manageable risk profile that can be well managed from the investment side. But the reason it's such a good thing is because it shares the longevity risk across the individuals in the plan. So from an individual perspective, rather than me just investing in my 401k or in the US or my RRSP in Canada, I have to plan for my own longevity, and I'm going to assume that I'm going to live till I'm 90. And so I have to plan to live till I'm 90. But if you put me in a pool with a bunch of other people, you can manage to people living to more on average till they're 84 or whatever it is. So the pooling of that risk is what really creates a benefit, because the people who die earlier are the ones whose money stays in the plan, and it benefits everybody else. So
what about the spouse?
The spouse will stay on and so on. But the pooling of that risk is a huge benefit from the sort of the societal perspective. Can we do a better job in designing plans that are less likely to end up in funding deficits? Yes, there's lots of ways to do that kind of combine the best features of both. But the risk transfer in going from a pure DB to a pure DC, defined contribution model, is a sad one, because it means that you transfer all the risk, all that longevity risk, back to the individual who has no mechanism to hedge it at all, and the pooling's gone. So you also lose from the pooling, you lose the ability to reach scale. So mostly the DC investment opportunities are more expensive, you pay way more in fees, and you lose because of that. So it doesn't, in the end, benefit the average person. So it's not the panacea at all. And the other problem that the DC world hasn't yet really figured out is when you reach retirement age, you get a pool of money. Well, what are you doing with it then? You're out of the plan, and we haven't really solved the problem at that stage of what are you doing with the money? Because guess what? The investment industry has figured this out, and investment advisors go and poach people. And they go, oh, look at you. You have this pile of money now, and what are you doing with it? I can invest it better for you. And then they go and pay retail fees at 2% off the top every year to somebody who may or may not have a clue what they're doing. And people are quite vulnerable to not investing well at that stage.
It'd be really interesting to hear your follow-up to what I have to ask Carl. But just to play devil's advocate for a second, if we think about a DC plan, they give people the flexibility to essentially recreate a DB inside of it. I mean, if you want to have a more riskier approach, you can definitely invest in more riskier assets, or you can buy. There are these contracts, deferred longevity annuity plans, where the insurance company essentially initiate a payout at a certain age after retirement that go on until for your life. Do you believe that it's a viable alternative to DBs to essentially recreate a DB payout within a DC offering?
I don't think so, but a lot of people have no choice. So they get to retirement, they have their DC plan, or they have that pile of money, like Marlene said. And what do you do with it? I mean, you just use it yourself, or you go see an insurance company to help you with it. And then that one person is in front of that huge company. How does that person knows that he's paying the right price for it? So it's but they might have no choice, so they just do it, and they pay high fees and who knows what. So it's too bad. And also those DB plans, those pension funds are great, but you need a really good team to manage them. So I understand a lot of companies where their core business might be technology or airplanes or whatnot, and might not be managing money. So they have these teams within those businesses managing money, and then you say, well, it's not core to our business, so let's take that managing of that pension fund and let's put it somewhere else. I can understand why they would do that. But then if you're big enough, then you can afford to have that team. So it's a matter of scale.
Yeah, I'd add one point to that. That is, at CN and many corporations who are prudent managers of their DB plans, they view them as a really strong tool for attracting and retaining good quality employees.
Yeah.
Because these plans are fewer and farther between, and mostly in Canada, they're mostly in government jobs and not in the private sector so much.
That's one of the main reasons we kept ours. It's really retain people.
Yeah.
So then you think twice before leaving your company. You have a great plan, and you go outside and you have no plan. So it's like, okay, for the same salary more or less, why would I go out? Well, I'll stay. So it's a big retaining factor.
And then, so I guess the question of the night before we open up the floor for Q&A is maybe I'll have Carl, you start on.
Am I the baby there?
No. But so if you today,
Builder for pension.
if you were a so many of the risks and factors we talked about that affect pensions today, very difficult to tackle, right? A lot of stakeholders throughout the past, they've essentially been kicking the can down the road. Not a lot in the U.S., especially on the public side, large reluctance to take action here. So if you were a policymaker trying to come up with one novel initiative to get every stakeholder on board today to address, if you're in the U.S., the large underfunded ratio, what would you put forward?
There's no magic bullet, but I have two ideas for you. The first one I already mentioned it. Make it clear that your expenses for your salaries at the same equal step as the fees you're paying for outside managers. So you can have better teams inside and lower your fees and having better expertise inside. That's the first one. Second one is those big funds that have all that great powers inside them, they have scale, they have those teams, they pay much less fees. So and most of them, like the one in Canada, are public. So I would tell them keep some space for your team to manage smaller pension funds out there, cities and so on, and some of them are already doing that. So you make it, I don't know about mandatory, but maybe at least part of their AUM, asset under management, that they have to help those other funds or even retail. So people could say, okay, I want my money managed by one of those big public pension funds. I will have access to all those great asset classes. I'll pay a very small fee. And why would I not? Why don't I have access to that? I should, right? And then so some kind of law like that. I mean, might be really worth it.
How about Marlene? What's your novel initiative to tackle the?
Well, there's certainly no magic bullet, but one of the things that at CN that happened that could be a useful model is in 1968, the CN Investment Division was created. And at that time, the division was created in order to manage the pension fund outside of the corporate, well, it wasn't even a corporate entity at that time. It was to make the pension money very much distinct from the assets of the organization. And at that time, CN was a Crown Corp. So one of the reasons for separating the CN Investment Division from the organization and physically separating it, we're actually in a different building. So unlike most corporate pension plans where, the team that manages it sits, somewhere near the CFO's office or is the CFO's office, we actually have a separate, we're a separate building and have very much been, it's across the street, but but nevertheless, but there's been very much a very distant, like very much a wall between us and the company. And that was a historically important thing because at that time it was a government-owned entity. Mm-hmm. And the feeling was that we don't want the government getting their hands on the pensioners' money. And that governance shift, if you could make that governance shift happen in the US and really separate these public plans from government, stop putting government appointees on these boards and truly make the boards independent, that is really what was the key for our organization. and was the key for the Canada Pension Plan and is the key for most of the public pension plans in Canada, where their governance model, they're very different, by the way. If you look at the Canada model plans, they have very different governance models. Who appoints the board? What kind of risk sharing is in the plan design? They're quite different from each other. But what they do have in common is really quite a significant wall between the pension plan and government, and what kind of power the government has to appoint members of the board, or to even make any of the investment-related decisions. So if we could just get them out of the government and really separate the governance, it would go a long way. But it's a really challenging thing to do. But what it could allow is some negotiated solutions. As long as you've got government on the board, really having any reasonable negotiated solution between the public and the funders of those plans is almost impossible. If you want to see some more models of how it can be done, just look inside of Canada. Prince Edward Island, New Brunswick, Newfoundland, they've all just gone through some really painful negotiations with their public plans that were underfunded and have had to figure out a way to manage their assets better, and they've all created a separate entity as part of that solution, and with stronger governance and less government interference in the governance model. So it's doable, and it's been done here. And there's been some give on the part of the taxpayers in order to make those solutions happen as well. They were politically difficult, but it's been done.
What's the largest? Why is it so hard for the U.S., for example, to have that separation? What's the biggest impeding factor? It doesn't seem easy to just replicate, right?
Yeah, I think it's probably a number of things. One being the extent of the underfunded status. Like you saw the data. Many of them are 30, 40, 50% in terms of what's funded. And it's virtually an unsolvable problem without some more money or really sacrificing what benefits the pensioners are actually ever going to receive. That's a huge barrier. And the politics of whose fault is it, and what's the responsibility of government? I don't know that they can solve that. So.
Great, and with that, we're ready for to open the floor to some questions. Great, thanks. So I guess whoever is most comfortable with the question, feel free to jump in and give us your thoughts. So here, our first question.
The lightning round.
All right, bring it on.
Lightning round. First question. Do you see any way by which U.S. public plans can realize the scale economies that Dr. Carl Robert spoke about? So I guess the question is, why is it so hard for...
Well, I don't see why not. CalPERS is a good example. They definitely could do it. It's just, somebody would have to be elected in California and then say, we're going to make CalPERS a great... more independent in a governance, like Marlene was saying, and they have they have hundreds of billions under management. They definitely have the scale to do whatever they want. So it's just a matter, in their case, it's just a matter of governance. And you have a lot of other funds like that. So a lot of them, they actually could improve themselves easily.
Does it tie back to talent as well? Does talent...
Well, yeah, the competition is a bit... I think in Canada, we talked about it a little bit at the beginning. In the US, it's just the competition is really, it's really rough. You have, private companies everywhere, spawning everywhere. In Silicon Valley, all these companies spawning up, hedge funds everywhere. You come out of school, we just go work for a hedge fund. Is it exciting? You come out of school. So why would they go work for a big pension fund that might look boring, but it's actually great. But but they have that perception that it's not cool and they won't work there. Same thing with insurance, and we have sometimes a problem to attract people. It's great, but I don't want to work for an insurance company. But actually you can manage money for an insurance company. Yeah, it's a lot of fun. It's a lot of action. But you don't know that, right? Yeah. So, yeah.
Yeah.
So it's tough to attract people.
Yeah, I would also say it's certainly possible to consolidate assets to get the scale, but I've lived through a few where the actual reality of consolidating pension funds is full of potholes. So, for example, at HOOP, Healthcare of Ontario Pension Plan, it took, I would say, I don't know how many, 5+ years to get a few new hospitals into the plan. And it was negotiated for a long, long time. And some of the barriers are plan design is not the same across these plans. And HOOP was in a surplus position, the main pension plan. And so when you have other outside pension plans that you want to consolidate, as opposed to being an investment manager for those pension plans as they are, if you actually want to pool the assets and truly consolidate the pension plans, there's big barriers. Because if the plans that want to join are in deficit and the plan they are joining is in surplus, well, you can't buy in unless you pump it up and put some money in the plan. So that's a problem. But if what you want to just do is consolidate the asset management and become an asset manager for separate pension plans that maintain their separate governance and their separate plan design.
Like the case is.
Yeah,
that's a good
the
example.
case, Alberta Investment Management, BC Investment Management.
So the liability is dealt with the pension fund, but the assets is managed by an asset manager. And one of those asset managers are one of those big funds that we have here.
Yeah, so you get scale, but you still have some challenges in managing that scale when you then have to have separate pooled funds that you put together into a portfolio. It's a very different model than being able to have the asset liability problem solved individually for each pension plan with the expertise that is needed to do that. Because when you consolidate those smaller plans, AIMCO, for example, BCIMC, they still have to have client relationship managers in the Caisse de dépôt. And they all struggle to have the right conversation about governance and about what's the right asset mix for that pension plan, because the governance is still sitting in the small pension plans. So there's no panacea here. You want to solve the problem, but you keep the governance model the same. Putting it in scale solves a part of the problem, but it doesn't solve the whole thing.
And it sounds as if with scale, it's really a question of balance. I mean, you mentioned when a public plan reaches $1 trillion AUM, I mean, is it going to be much harder to manage that scale efficiently?
I mean, look at Norway. I mean, it's more than 1 trillion. And they got money from oil. So basically, their business model is that they don't invest in oil companies because they got their money from it. Yeah. So, they're pretty successful. I mean, but there's not I mean, it's not an easy answer for that. I mean, because when you become much bigger, it's much more difficult. I think your expected returns go down if you're too big.
All right, here we have a second question. So you both have a quantitative background. How do you see machine learning and AI changing your investment process, if at all? Do you believe that factor investing will grow as a greater share of trades in your activities?
Oh, yeah, I can do that. Machine learning it's going to replace a lot of managers. One of the problems. I mean,
so much for your careers.
Yeah, it's going to help. I mean, first it's going to help managers a lot because it's another tool. But those strategies, I mean, the problem is if it's a black box, even if it's doing better, as soon as you reach, you go to a drawdown or a downturn, and you cannot explain why you lost money, they're going to pull the plug. So the key is to have a machine learning algorithm that it's transparent, that can explain to you which and what factor are doing what. And then you can say, okay, you go see your boss and say, okay, I made money this month, and that's because of inflation, let's say, for example. Because, even though it's the machine who did it, you can explain it. So that explainable AI is very important in investment. I mean, we've been running strategies with machine learning as pilots, and we just beat the strategies. But then, you go see with upper management and say, well, why do you beat them? I say, if you cannot explain it, they're not going to adopt it, right? But some of them adopt them and they use them. But I guess at some point you'll be able to explain them, and then that's key. And then factor investing, it's just another way of seeing asset classes. Instead of looking at asset classes, you look at factors. But at the end of the day, it's the same assets. So, it's a nice way of saying which risk factor or explaining what. It's great, but I don't think it's necessarily much better than looking at geography or assets. It's in vogue, it's nice. Some of it is great, but I don't think it's going to answer all the questions.
Yeah, I'd add a little to that I think the factor-based investing has a number of dimensions to it that it goes a little beyond asset class. So, the academic risk premia that hopefully you've all learned something about, value, momentum, that, the size premium, that these are factors that they're kind of like the pennies sitting out on the street that the quantitative approaches can kind of pick them up off the ground, and they're alternative risk premia that are out there that are not straight up equity risk premium type exposures. So the quant models, I think, are doing quite a good job on that. They've performed really badly this past little while as we had a 4 standard deviation event in value underperforming terribly. But generally speaking, having some allocation to a smart quant strategy that is focused on alternative risk premia and done ideally through a variety of implementations. Like the way we do it is we have 3 external managers who have different approaches to the factor-based investing category, different time horizons that they focus on, different instruments that they use to implement, different portfolio construction methodologies. And so we've kind of diversified our exposure to the factor-based investing category. And it has shown in diverse performance across the different managers. So it sounds kind of simple in some ways, but there's actually many variables in how you actually implement. So there's still a little, somebody has to program the computer.
But it's great for, I was talking about benchmark earlier. It's great if you want to build a benchmark and let's say you want to target, let's say I was talking about operating income. Then your factor is operating income, and you build your benchmark with that in mind. So they call it alternative beta. So you get a beta exposure, but it's alternative. So it's one way of building good benchmarks.
But also for the kind of AI machine learning, I think your comments were right on, and I would say that where we'll see more sort of near-term success there, and we've got an experiment that we've done a pilot project on using not quite full-on AI or machine learning, but it's pretty close. It's more data, alternative data, sophisticated analysis. That it's sort of helping us. It's sort of a very sophisticated screening tool kind of idea, and incorporating that into our bottom-up equity fundamental analysis as a way of helping us focus our energy on what are we going to use that deep dive analysis for, and if the idea behind it is if we like this company and that company, let's plug it into a quant methodology that tries to find companies that have similar characteristics, that kind of the idea. So it's sort of an assisted approach to how we do our fundamental analysis. So those are the kinds of things that I think many managers are finding that this, it may not truly fully be machine learning. It may not be a full quant strategy that just runs on its own, but it's part of a process that is smarter than the people.
In insurance on our side, it's a different story. It's a game changer. It really is. So you tackle different type of problems, and actually, it's becoming part of the curriculum now. In the CFA exam, they're going to have a part on machine learning. But in insurance, the pricing of a premium, the claims, it can be used very efficiently. There's a lot of inefficiencies, and you have this huge amount of data, huge. So it's a big game changer.
Yeah. But I want to tie back to the first question you asked for a second about our quant backgrounds and why it's useful. And it's been quite interesting to me over the last couple of years as machine learning, AI, and factor-based investing have been these hot topics. And, I kind of ask questions and dig deeper under the surface of what's happening. And it's not like there's new math all of a sudden. And it's not like there's new strategies all of a sudden. It's largely that computing power has gotten so much better that our ability to kind of do the same stuff we were doing 20 and some of us 30 years ago, that it's just far more efficient. And so you can apply what we thought was really cool ideas, in that day and age when we had computers that chugged along and, doing an optimization problem and trying to find
And it's cheap now also.
trying to find the top of the maximum likelihood hill, and it was like 20 minutes later on a two-dimensional problem. So, a large part of it is really just the efficiency of both memory and computing power.
And it's cheaper to have a powerful computer. And sometimes you don't need any computers. You do it on the cloud. All the algorithms are free. The best AI are free on the web. Or you just the development in universities they use AI. The subroutines and algorithms are available for everybody. That's great to be a student right now and studying in that. I mean, there's going to be a whole new world out there.
Now, this next question, I don't want to put you both on the spot, but the question reads, so what will cause the next financial crisis? And I guess you can take it as whatever you want, but maybe, sure, what will cause the next financial crisis, or maybe what's keeping you up at night in today's current environment? What are you most worried about?
Yeah. I look at inflation. I'm a bit worried about stagflation, like I mentioned earlier. With that trade war going on, it's really induced a lot of, we don't see it much yet, but inflation is starting to show up a little bit everywhere. Still really under control, but it's definitely something to look for. And it's starting to, unnerve the markets. Another big one is China. I mean, every morning I wake up and I open my tablet and I look at the Financial Times, and I look at my map of the world, and I look at the markets, and I see China in red, -2. What's going on there? And when we track China, it's difficult to know what's really going on over there. The debt is huge. There's so much debt, and a lot of other governments have a lot of debt as well. So debt, a lot of debt was taken by the governments during the crisis. It was companies going bankrupt and so on, and the balance sheet of governments went way up. So that's pretty much and in Canada in particular, the consumers really a lot of debt. The consumers is really up to there. So if the interest rate goes up too much, could be an issue.
Yeah, I think we're not going to see a financial crisis like the last one. I think there's been enough improvement in regulation and sort of the settlements of derivative contracts that have really improved kind of the counterparty risk factor, and I don't think we're going to see a similar sort of financial crisis. Leverage is important in the economy, but we have much less leverage inside of structured products. We have much less leverage that's hidden in kind of financial instruments. It's more obvious, better reported, better governed. So I think it's just going to be a different issue and more of a traditional downturn, more of a traditional recession kind of trigger, which is kind of what you're talking about.
Are you worried about credit at all?
Yeah, I'm worried about credit. But being worried about credit is, as far as I'm concerned, is the same thing as saying I'm worried about the equity markets. They're so closely correlated. I don't really think they're distinct risks. There's a bit of different sectoral bias in credit markets versus equity markets as a whole. But so they're the kind of the same risk as far as I'm concerned. But I worry as well about China, that if the Chinese policymakers get it wrong, China has been the big driver of global economic growth for 15 years now, and is really still the big driver. So how much do I worry about that? I worry a fair bit, but the incentive of Chinese policymakers is so strong to just keep pumping stimulus into that economy that I think the risk is quite
Yeah.
muted of
And
it
they have a
really being a
clear long-term
disaster.
plan.
They have a clear long-term plan, and they really, really, really want to avoid social upheaval. So that's a pretty powerful motivator for them to really continue to just pump, whether it's fiscal stimulus
Yeah.
or monetary stimulus into the economy.
And they're doing it right now.
Yeah, exactly. So yeah, it's a concern, but I think ultimately it's not. They're not going to go into recession by
Yeah.
any stretch of the imagination. But the other side is another way of saying what you're saying is sort of a central bank policy mistake. We're in this zone of never having had central banks with these giant balance sheets that they need to unwind, where they've purchased corporate and not just government bonds, but corporate bonds. And in the case of Japan, they've actually invested in the equity market on the central bank's balance sheet. So there's a whole lot of unwind that needs to happen there that we just don't know how that's going to work. And the U.S. economy, you know, it seems to be doing just fine, but the equity markets are struggling with digesting the information flow right now, and they're struggling with digesting any negative news because there's uncertainty about whether the Fed's going to raise rates too fast.
Yeah.
And so they're kind of, you know, the technical term is puking on the interest rate hikes, and that they're kind of that sort of backdrop means that any negative news that's coming out that is related to trade wars or political outcomes or, you know, more divisive governments is not being digested well by the markets. But I'm not really worried about the economy itself that much. It's much more
Yeah, it's
about
geopolitical.
valuations at this point.
Yeah.
And I guess with that, thank you very much to both of you for a great answer.
Thank you, Isaac, and thank you, Marlene and Carl. We feel very lucky to have all of you with us tonight, so we appreciate it. Thank you for an awesome discussion, super insightful, and I'm sure everyone enjoyed it. With that said, I'd like to invite everybody to join us for the opening cocktail of MIPC in the main area over there. There'll be some drinks, some food, and then in about 30 minutes, we'll have a speech by Luc de la Durantaille from CIBC Asset Management. So please join us. Thank you.